Good morning, traders. Welcome to another webinar on titled Profit and Risk Measures. For those of you unaware who's behind the mic, my name's Aaron Hill and I'm one of the market analysts here at FP Markets. Now, for this webinar, I feel it should be a quicker session than previous presentations as the subject is a little more defined, as I will be explaining some of the information a trader must understand when reading their statement reports. All brokers send out monthly, weekly, and I also believe annually as well. Now, do note that the slides for this webinar will be on the basic side, as most of this is focused on, as I said, the measures. Some may have been likely turned off by the title, as I guess identifying the measures on one statement may not seem important or as exciting as you know, smashing home runs on the charts. I totally understand that, but in my opinion, these measures are very, very important. Understanding these values allows us to compare and evaluate standard measures of, you know, system profitability and risk. I must be clear, some of the measures I'll talk about are not covered in your MetaTrader report, while others will be. MT4 allows you to, as far as I remember, MT4 allows you, or MT5 as well, allows you to generate a detailed report. I believe you simply right-click the account history tab and select Save as detailed. As usual, there should be no issues with sound or the slide deck, as these were double checked before going live. Do be sure to let me know if there is, and we'll try to get you up and running. It's fine to fire across any questions you have during the presentation. Bear in mind, I'm not Isaac Newton. So any complicated maths may be best left to an email where I can ensure that I'm getting the correct information to you. I see we have a couple of questions already. Just give me a second. Would you please tell us how to calculate the PIP when we are trading cross pairs? Joseph, this is a webinar on profit and risk measures. I believe I have done a webinar on PIP calculation, maybe not the webinar. I've certainly wrote an article on that, so if you want to check that out, feel free. But for the purpose of this presentation, it's on profit and risk measures, and we won't be covering PIP value. Look, if I have time at the end, I may try to give you a brief overview of the PIP calculation. But yeah, so as I said, please do feel free to visit the article I wrote on the FP Markets webpage. Can we have your email to ask questions from you? Yes, Joseph, I will be giving that in shortly, and you can ask from me or anyone from the research team. Morning, Daniel. Good to see you again. Okay, let's kick this off with the disclaimer as usual. Look, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. FP Markets does not give any warranty or representation as to the accuracy, reliability, or completeness of the information contained in this material. Again, guys, what this is really saying is it's not investment advice. This is purely an educational session. Excuse me. So presentation topics here are pretty much self-explanatory. Learn to read common profit measures. So I'll take you through the important measures one by one that we as traders need to understand when reviewing our statistics for profit measures. With profit comes risk. Understand what risk measures are telling you. Look, I'll do the same with risk measures as I do with the profit measures. For any questions I miss, it is here at the end of the session. I will try to get round to them. As I say in all of my webinars, Any questions missed, or those that require more of a detailed reply or answer, email me and the research team at marketanalyst@fpmarkets.com. Just bear with me 1 second, and I'll copy and paste this into the chat box. Joseph, this is the email you can reach me on if you want to contact me regarding any questions, and I'll get back to you as soon as I possibly can. Just bear with me. Okay. And also, please do use this email if you want to suggest any webinars we can we can create in the future. Okay. So kicking off with the very basics, before we get into any of the measures, you must understand that some reports, or should I say most reports, will come with an equity curve. And some may also have, some of the more advanced reports will have the option of viewing an underwater, I believe will have the option of viewing what's known as an underwater curve. So look, an equity curve shows the level of equity, in one's account over time. Ideally, we all want our equity curve to be to the upside, of course, ascending in a smooth manner to the right rather than falling. To the right, we can see a rather negative equity curve. Ideally, this line should have continued lower, of course, to show that this was a negative equity curve. And as you can see, 10,000, this would have been 20,000 minus, 30,000 minus. Above, as you can see, we're all in positive. This chap here has done very well. But yes, these are the equity curves. So just bear in mind, positive equity curve, negative equity curve. Dips on the rising equity curve are created by what's known as drawdowns. And these are essentially the losing trades in our account. So this is where our equity increases, and this is where our equity decreases, increases. So think of it, for those who follow technical analysis, we'll see that this is simply a trend. Higher higher low, higher high, higher low, and so on. Any questions from this, please do fire them in the question box, and I'll get an answer to you. Yeah, Daniel, would you not be able to see if you keep a diary or have something like Edge? I don't understand what that is, Daniel. Sorry. Maybe you can maybe explain what you mean in a little more detail, and I'll try and answer that. So look, on the screen, next up is the underwater curve. Now, an underwater curve may be new to some of us here, especially for newer traders. All it is a graph that looks at the strategy's performance from a slightly different angle, essentially displaying the drawdown seen following each successive higher peak in equity. Now, do note the underwater curve is calculated in percentages. So I thought this was a perfect image, and this is sourced from managedfutures.com. As you can see, this is our equity curve in red. So as I showed on the previous slide, let me just go back, and this is our equity curve here. Okay, and so this is our equity curve at this point here, and this is our underwater curve. So our underwater value curve is positioned to the right hand, and the equity curve and the equity values is positioned to the left. So as you can see, we have a higher peak in our equity, followed by a subsequent dip in our equity. And this is demonstrated through the underwater curve. As you can see, from the higher peak at this point to the higher low, our drawdown was on the doorstep of 10%. So this was a 10% drawdown. So look, the underwater curve shows us how much of our drawdown is. How much our drawdown is within this this dip. And as you can see here, we had a slightly larger drawdown, eclipsing the 10% mark, which is probably around 12% here. So higher peak, dropping down to the higher low, and this is at 12%. Now this was a whopper. This come in at 20% drawdown. As you can see, the underwater curve shows this at 20%, and here's the equity line. We had a higher peak here, and now we're in a considerable drawdown, reasonably considerable drawdown. Now, any questions, please do fire this across on the underwater curve. I understand some trade. This would probably be the first time a trader newer traders have seen the underwater curves. So Daniel's asking about a trading diary software where you can see your curve. Oh, I see. So Daniel, this software has the underwater curve. I would imagine on the platform, right? Okay, so look, while he's typing, I'll just move on to the next slide. This is number of trades. Now, look, this is usually located within your trading statement on the basic that you should receive every month from if you're with FP Markets. Look, so the number of trades, the larger the sample, the better. Why I say this is the larger the statistical sample we have to work with, the smaller the deviation from reality. I hope that makes sense. So look, we don't want our number of trades to be 5 per year. We want a considerable number of trades to work with, especially considering, so for instance, if you construct a backtest, you don't want your backtest to be simply 5 trades. You want your backtest to at least be 30 to 50 trades at least, and that's the minimum for me. Ideally, you want at least 100 trades for me personally before I have any trust in the system. So ideally, you want your number of trades to be reasonably high. Initial deposit. So as its name implies, this is simply the amount a trader deposits in his or her account to begin trading. Now, this could be as low as $100 US, which I believe is the minimum funding requirement for FP Markets, or it can, it can range as much as the as the trader feels comfortable with. So look, common deposits, as far as I know, range between $1,000 and $10,000. However, I do know of professional retail traders that trade with much larger account sizes. So look, gross profit is the gross profit and gross loss. So look, gross profit is the result of all your profitable trades. So if you had, say, 30 trades and 15 were winning trades, the sum total of those profitable trades made is your gross profit. Now, of course, gross loss is simply the mirror opposite in being the sum total of your unprofitable trades. This should be pretty self-explanatory, this one, and there should really be no questions on this, to be honest. Next up, we have, of course, net profit, which is simply the difference between your gross profit and gross loss. When I say difference, this is the minus value. So if your gross profit on the, let me just get my handy dandy pen. So if your gross profit was, say, excuse my handwriting, by the way, gross. So if your gross profit on the year was, say, $30,000, and your gross loss was, say, 20,000, we minus these two values to give us 10K, which is your net profit. Okay, so it's pretty simple. Ideally, we always want our net profit to be in the green, so positive values, meaning our profitable trades exceed our losing trades. I believe many traders also refer to this value as their bottom line. However, while having a strong bottom line is important, it's equally important to understand what risks we are taking to achieve this bottom line. This is really important. This is if we are taking excessive risk to achieve that profit, so that profit of, say, 10K, as I just noted, we have to ask ourselves how long before our account suffers a nasty drawdown, or even worse, an account ruin. So what I mean by this is if we're risking, when I say excessive risk, I mean the maximum drawdown is, say, 30%, but our our net profit is, say, 10%, is that really a viable long-term strategy? You have to ask yourself, like, in between a net profit and risk. So this is where it becomes very, very important. Annualized rate of return. So look, another measure we have to acknowledge is this, the AROR, which includes compounded interest. So annualized returns are returns that are returns over a period that's scaled down to a 12-month setting, allowing us to compare returns over any period. So for the calculation, now don't freak out, this isn't that bad. The calculation involves summing the starting point, which I have labeled initial account value, summing the starting account value by the gains or losses over that period, then dividing this value by the initial account value. Following this, we raise this to a certain power and -1. So as a quick example, imagine we have, say, an account that's been trading for 4 years, and we want to know the annualized rate of return of the system being used. So let me just click on the pen. So for this example, the initial starting value, let's say it was 20K. Okay, we have a $20,000 account, and say we gained, over those 4 years, we gained a respectable 10K. Okay, this is our gain over those 4 years. So the calculation to find the annualized rate of return is we sum the 20K to 10K, which obviously is 30K, and then we divide that by the initial account value to get of 20K to get 1.5, if my maths is correct. So that gives us 1.5, and then we raise this to the power of 0. Let me just write this on 0.2. Oh, whoops. Let's scrap that out. 0.25. I hope you can still read that. 0.25. So we raise this value 1.5 to the power of 0.25. Which is, of course, 1 divided by n, which is the number of years. So this is 4, and 1 divided by 4 is obviously 0.25. And we then -1, as we can see, -1. And then obviously to get the percentage, we multiply that by 100 to get, I believe this comes out to 10.6% annualized rate of return. Now, if you want, do this calculation yourself, and so I'm not 100% sure if my math is correct. I just did that in my head, so do point me out if I'm incorrect with this maths here. But yes, this is an example of how you would calculate your annualized rate of return and what it's used for. Okay, next up is profit factor. Profit factor is a cool measure, and I do not believe this is on your main reports from MetaTrader. But look, this is a ratio of the gross profit to gross loss. So what we are doing here is dividing the your gross profit to gross loss. As I said, we are dividing the gross profit to gross loss, but with the net profit, we are obviously going to be minusing the values. So profit factor is a metric that should always be above 1, or the strategy you are using is a loser. Ultimately, I personally, for me, I look for a profit factor of 2 or more, and is usually, just bear with me, and is usually, I see some questions coming through, just bear with me. Okay, so look, and is usually, so look, as I said, the profit factor I use usually I look for is 2 or more, and is usually the first measure I take note of when analyzing a system's performance, be it live results or from a backtest. So just to give you a quick example of profit factor. I don't think I need to write this on the screen, but I'll just do this so it helps new traders understand. So look, just to give you an example, profit factor of 0.8, which you'll note is not a very good number. Means, look, if you invest, say, 20K in a system, you can expect, we multiply that by 0.8. You can expect to receive around $16,000 return. So it's a losing strategy, basically. It's not ideal. So as I said, always pay attention to the profit factor. It should always be above 1. As you can see, this is a losing system. Okay, so look, if you now a profit factor of say 1.8 on using these same values we can expect to nearly double our return in this instance here of 1.8. So 20,000, so 20K minus 1.8 in this case, it gives us, I think it's around a $36,000 return. So it's like it's a $16,000 return in this case. Okay. Also, something I feel it's worth pointing out for any newer traders present, and especially for those in the process of looking to invest money in a trading robot that's highly advertised nowadays, that guarantees to deliver X amount of profit. When you analyze their performance, do take note of the profit factor. This is a key metric, guys. So an excessively high profit factor is an alarm bell. So a profit factor greater than 10, for example, echoes a strong possibility that the system you're about to purchase has been curve fitted. This is easily done when you're trading robots, when you're trading algorithmic systems. This is easily done using just the in-sample data and completely disregarding the out-of-sample data test. So the out-of-sample data test essentially tests the viability of the system that was designed on the in-sample data. I think I did do a webinar on this, and we briefly touched on this, but the in-sample data is where you do most of the optimization, and then on the out-of-sample data, this is where you get your results, basically, of that optimization. And this is, as I said, this is for system testing, system strategies, not the, so what am I thinking of here? Not the, so it's a non-discretionary system, is what you'll be working with there. Worryingly, so a high profit factor can fool many unsuspecting clients who buy into those systems. So do keep an eye on this value closely. Another metric to be aware of is on some reports is known as the outlier adjusted profit to loss. So although bearing a reasonably long-winded name, all the outlier adjusted profit to loss is a measure adjusted for the largest profit. This will make sense once I explain it. So the idea is we do not really want a strategy where that relies on that one big win. So without removing the largest profit or profit, our profit factor could be extremely high. Remember, our profit factor is found by dividing the gross profit to gross loss, and we want it to be above 1 at least, preferably 2 or more. So if our strategy provides a profit factor of, say, 3, so imagine a system offering 30,000 gross profit and 10,000 gross loss, for example. But when we remove the largest profit from that from the calculation, and the profit factor dips under 1, this could be a troublesome system to trade if we do not get that big win. We need to bring the system into that same profit in the future. So look, a point I must make is that many agree that the largest winning trade should not exceed, I believe it's 40 to 50% of the total profit. So what they're saying is, we do not want a system that returns, say, 8,000 US dollars in 1 year to have the largest winning trade exceed 4,000. Now, guys, are you clear with this outlier adjusted profit to loss and the profit factor? If so, I'll continue. If not, just ask me ask me any question. Ask me in the question box. Thank you, William. Good. We have a question from Daniel. At what percentage drawdown do you step back, stop, and review your psychological state and strategy? That's a good question, Daniel. But look, this is really trader dependent. For me, I'm very conservative. If my account drops by 20% or something like that, around that mark, I'm out. There's something wrong for me. In that case. But look, some traders do work with 40%. I know some traders who work with higher than that. This again is, you know, this is really trader dependent and something that you'll have to decide. What is your limit? What can you? So if you have, say, a 10,000 US dollar account, can you stomach losing 5,000 of that and continue trading and continue making objective trades? If you can't, then you need to consider where your threshold is before you cut back. I hope that answers your question, Daniel. I'm sorry I can't give you a definite answer on that, but as I said, it is trader dependent. Okay, look, expected payoff is one I see on the MT4 end of month reports. This will be at the, if I remember correctly, at the top of your statement, generally under the gross loss value. Now, this is calculated by dividing net profit. Again, net profit is the gross profit minus gross loss. Net profit by the number of trades taken. So if the average return, so it's essentially the average return from all closed positions. For example, let's say you have 100 trades in 1 month and made a total net profit of, say, $1,800. That means the expected payoff is, I think, $18. So what we do is simply divide 1,800 by 100, and that gives us $18. Obviously, this metric must be greater than 0 for a positive expectancy in your trading system. So do keep an eye on this. It should always be above 0 in your reports. Percent profitable, pretty self-explanatory, I would say. This is, if we take the number of winning trades in our trading strategy and divide it by the total number of trades and then multiply that result by 100 to give us the percentage, we get the percentage of successful trades. The question is to what extent this is a decisive indicator. Is this a decisive indicator for us? There are strategies with only, I'm sure most of us are aware, there are strategies with that offer only 30% profitable trades that generate much higher profits in the long run than strategies with 60% success rates. There may even be strategies with 60% of profitable trades that are losing in total. The answer therefore lies more in the average profit to average and the average loss for all trades and their ratio. So it's not so much the win percentage, it's more the average profit and average loss for your trades. And that leads us nicely onto the payoff ratio. Now, this may be something new to some of our newer traders here. And this is another profit measure. An important profit measure, I must add. From memory, this is not shown on your average summary statement, but it is certainly one to remember and can easily be calculated, I believe, from using your basic statement results listed under average profit and average trade loss. So average profit, trade and loss, should I say. So the payoff ratio, or the profit and loss, is your average profit per trade divided by the average loss per trade. So in simple words, the payoff ratio is the ratio between the size of the win and the size of your loss. If we have higher values, obviously the performance of your system is on the front foot. So just to repeat, it is basically the ratio of your average winning trade to average losing trade. For me, I always want to see this above at least 2. So that would be, as an example, that would be $400 win on average and a $200 loss. So all we're doing is dividing 400 by 200 to give us to get 2. Obviously, again, the higher the better is what you should look for. So if we have, say, 600, on average we win $600 and on average we lose $200. That would give us a ratio of 3. 200 average wins 200 to average losses of 200 would give us a ratio of 1. Again, I always look for above a payoff ratio of above 2 or 2 or above. Okay, next on the menu, absolute, maximum, and relative drawdown. These are really important risk measures. I did touch on this briefly, I believe, with the underwater curve at the beginning of the presentation. Look, so right, drawdown is the maximum loss from an equity peak. So the loss from peak to trough. This can be expressed as the amount of money or percentage of the largest decline in one's capital in our historical trades. As you can see, as you remember from the underwater curve, we can see historically how much drawdown we had. So as a quick example, imagine your account. Let me just get the pen out. Let's just imagine we have a rather healthy account of, say, 350K this time. We're quite a large trader, 350K, and which also hits a peak of, say, oh, sorry, let me scratch that. So during our trading, our account reaches a low of 350K. So our account could be at 500K, let's say. 350K is our low, and our I've done this wrong, I think. So look, imagine your account, let's scratch that last bit. Imagine your account has a 350K low and a 750K high. Okay, so look, the peak is 750K, the trough is 350K. All we do, we minus these two values and divide the peak, divide by the peak of 750,000, which I think gives us 53% maximum drawdown. Let me just work this out really quickly. So 750, we minus the two values, 750. So that gives us 400K minus divided by 750K. Yes, and that gives us about 53% maximum drawdown within that account. So essentially, all it is from the largest loss from the peak to the trough in your account. So in the example before, at the beginning of the presentation, our largest drawdown, our maximum drawdown, if you remember, was just a touch over 20%. Let me just erase that awful drawing there. Okay. So it's a value. So it's a value or a multiple of its value that is used to determine the size of the account for live trading in a particular market. So this determines the maximum acceptable risk and also stop loss before we trade live. Look, so what I'm trying to say here is we may experience a large losing streak when we initially begin to trade, right? The rule of thumb is to have at least twice the amount of capital seen in your maximum drawdown to begin your account. So this data can come from your, excuse me guys, this data can come from obviously from your back tests. For example, if our maximum historical drawdown in a particular market was, say, $5,000 US, we can say that our strategy requires an account with at least twice the drawdown value. In other words, we need a $10,000 account. Now, this is only a rule of thumb, guys. Obviously, it's up to you how you fund your account and how you work with this, but we should all have our backtest results to hand before we go live anyway. So you will be able to see your maximum drawdown, and this is on your main report, I believe. On that note, on your MT4 reports, you will have three values. I think it's absolute, maximum, and a relative drawdown. Now, the absolute drawdown is the largest loss that is below the initial deposit value. So if our deposit value was, say, 10,000, it's the drawdown below that value. Maximum drawdown is, as we've just explained, is the from peak to trough during the account's trading. Relative drawdown, this is the maximum percent account decline relative to the account balance. It's the same as maximum drawdown, but in percent. Okay. Long and short positions, 1, but in percent. Again, pretty self-explanatory, this one. The number and percent winners in long and short trades. So this shows how good the system is when trading long and short the markets. You should observe if there's an asymmetry with long trades, we have to look for possible reasons and solutions to this. So as an example, if your method is better served as a long only strategy, if your long positions prove more profitable, this is something we all need to take into account. I've never found a long only strategy really profitable. I've always used a long and short approach, and most of my trades are roughly equal, symmetrical in terms of percentage long and short one. Obviously they're not 100% the same, but they do average out to be a reasonably like 50-50, that kind of thing. Okay, and just quickly here before a few. Oh, and these are a few more on the MT4 report, I believe. So we have the average profit per trade. Again, guys, look, pretty self-explanatory, but for newer traders, this is something you should be able to understand. The average profit per trade is the average profit value that a trade, so it's the sum of profits divided by the amount of profitable trades. An average loss per trade, exactly the same, but only the other way. So the average loss value for a trade, which is the sum of losses divided by the amount of profitable trades. Max consecutive wins and losses in dollar value. This is the longest series of profitable and unprofitable trade positions and the sum of their wins. And as I said, these are all located on the main the statement that you receive from your broker. Okay, length of just 2 more, I believe. These are 2 other profit measures I want to highlight, which you will not see on the basic reports, I believe. I'm pretty sure they're not on there. And these are the length of average winning trade and your efficiency factor. Now, the length of the average winning trade is, as you would think, is the length of the average winning trade to losing trade. Of course, we want to remain in our winning trades longer than we do our losing trades. So we want the ratio to be at least above 1. So if our average winning trade is, say, 11 days and our average losing trade falls in over around 11 days, our ratio is 1. But say the losing trade stepped down to 8, our ratio is then is around 1.37-ish, I believe. This can be increased. So our win rate, our length of time remained in a trade for our average winning trade can be increased by using obviously trading stops and obviously cutting losing trades quicker. The efficiency factor is our net profit divided by gross profit. This shows, as its name implies, how efficient our method is, in that it demonstrates the percentage difference of net profit to gross profit. The general rule of thumb to have is this falls within 38% and 69%, I believe. Quite odd numbers, but just between 40 and 70%. So look, let me just quickly go over the efficiency factor once more. That's the net profit divided by the gross profit. As I said, guys, any questions? I'm here to help. Okay, these are slightly more complicated measures, and I'm pretty sure our newer traders here may have heard of these, but won't understand them. Kicking off with the MAR ratio, or sometimes referred to as a recovery ratio. This is the net profit percent as a ratio to maximum drawdown in percent. So let me repeat that. It's the net profit percent as a ratio to the maximum drawdown in percent, of course. Now, this ratio should also be above 1. So we're not really looking for our system to generate, say, a 10% net profit if we have to experience a 12% maximum drawdown. This just makes no sense to me. This would give us a ratio of around 0.83, I believe. So as I said, we always want this ratio to be above 1. What we're looking for is something, this is just a quick example, don't hold me to this, is what we're looking for is something like a 15% net profit with a 7% or an 8% drawdown in that period. Obviously, again, percent, giving us a ratio of around 1.87%. That's a much healthier ratio to be working with. Now, the Sharpe ratio, I'm pretty sure most of us have heard of these, and it's a performance measure that's widely used by industry professionals. Now, essentially, what this is a ratio of excess return divided by the standard deviation of periodic returns. I know this is a mouthful, but this is a really cool measure, and something you should spend some time learning, because a lot of detailed reports do have this. This is a classic measurement, allowing us to essentially see how much return we are getting when minused from the risk-free rate. As you can see on the calculation, return, the numerator, return minus risk-free rate. For the risk-free rate, you can think about bonds, for example. I think it's a 90-day bills, I think they use for this, but I think you can use any risk-free rate you want there. And then this is, of course, is divided by the standard deviation, which is your risk. Now, standard deviation is a statistical measure that's it's a measure of volatility. It shows how much variation, or sometimes referred to as dispersion, there is from the central tendency of the mean. Now, are there any questions on the Sharpe ratio before I go forward? So just to quickly expand on the standard deviation. All standard deviation is think of a bell curve, and you have the central tendency in the middle. That's your mean value of your account, the mean value, and to the right you'll have your positive returns, to the left you'll have your negative returns. So it's measuring the dispersion excuse me, guys, dispersion there is from your mean, how volatile your system is. So how many standard deviations it is from the mean. Sortino ratio is a very similar construction to the Sharpe ratio. The only difference is the standard deviation is focused on negative returns. So the standard deviation measures the downside variance rather than both the upside and downside variance seen in the Sharpe ratio. If you remember, the Sharpe ratio has a central tendency, and it measures the dispersion of your returns both for the upside returns and downside returns. But look, many consider the Sortino a better measure, as it focuses on negative returns only. Remember, with the Sharpe ratio, we measure the variance of positive returns and the variance of negative returns. But with the Sortino ratio, we completely erase the upside variance and just focus on the downside. So I think it's called semi-variance. Look, in the Sharpe ratio, we can get a really high standard deviation figure, which is our risk, as you can see on the calculation, by simply having positive returns. But that is what we want, and is not really a concern for us in terms when we're measuring risk based on the variance derived from our standard deviation. This is why the Sortino ratio is a much, in my opinion, I agree as well, is a much better measure of your risk-adjusted returns. So Sterling ratio. This is simply a simple moving average, or arithmetic average, of annual net profit. So our annual net profit, a simple moving average of our annual net profit divided by our average, I believe it's average maximum drawdown. Okay, any questions on these rather interesting ratios? Please do fire them across. And the two final measures that I believe are well known by many of us here. I know they are used by many of us. So it's the win-loss ratio and the risk-reward ratio. Now, the win-loss ratio is pretty simple. It's the ratio of the winning trades to the losing trades. So I think it's the average winner to average loser, which is easily computed from basic data. So if we say we have 50 winning trades and 40 losing trades, your win-loss ratio is, say, 1.25. If you have 40 winners and 20 losers, your ratio is 2. So your trades win twice as much as they lose. That's all that is. A win-loss ratio is pretty self-explanatory, that one. A risk-reward ratio. I know its name is commonly referred to as the risk-reward ratio, and I've wrote that on the slide, but I see traders often confuse this ratio and compute it as their reward to risk. I've been guilty of that in the past. You will often see many traders say my risk-reward is 2. But if you think about it, if your risk to reward is 2, that would mean they're risking, say, $1,000 to make 500 if you follow a risk-reward ratio structure. What they have done is simply calculated their reward to risk. So that would be 1,000 divided by 500, which of course will equal 2, and shows that for the $500 risk in the market, the expected return is twice as much, so 1,000. So do keep that in mind when you hear someone say my risk reward is 2. That means they're working with a very a very unsatisfactory system. But I think what they're referring to is reward to risk in at that point. Now, okay. Q&A, guys. Any questions on any of those? I know I've thrown quite a lot of at you, but look, there will be there is a recording of this presentation. Do go through it, and any questions you have, you can fire them over to me at the emails on screen. So either support@fpmarkets.com or marketanalyst@fpmarkets.com. But look, if you want direct access to me and the research team, marketanalyst@fpmarkets.com is the more direct way of contact. We have a question from Joseph. What is a robot trader? Has FP Markets a robot trader? Is it reliable? No, look, a robot trader, I should have really been careful with how I phrase that. So a trading robot is, as far as I'm aware, I've never traded with a robot or anything like that, is a non-discretionary system. So it's basically a mechanical system that you the computer makes the decisions for you. So the computer decides when to buy and sell, and that's formed by inputs from you when you build the system. That's all that is. And no, FP Markets does not have a robot trader. We do have copy trading though, which you can copy profitable traders. Now, this is a good opportunity to go and view their results. You can look at their results and compute whether they are successful, whether they have good results or not. Okay, Dahlia, the Sortino ratio equation. Do you want some extra? Do you want me to go over that again? The Sortino. Just type in YRN on the chat box if so. I assume you do because you've typed that in there. So let me just get that back up. So look, all the Sortino ratio is essentially the brother of the Sharpe ratio. The only difference is instead of the Sharpe ratio, instead of what the Sharpe ratio does is take the upside variance and downside variance into account. When I say upside and downside variance, I'm talking about upside returns and downside returns in your account. All the Sortino ratio does is completely erase the the upside variance. It's not risk, is it? This is what we want. We want the upside variance, but the downside variance. So the return minus risk-free rate. I believe it's actually minimum acceptable rate. So this can be anything from the bank rate you receive. Return minus risk-free rate divided by risk, which is your standard deviation of negative returns in terms of the variance. I hope that helps. There's not really much I can say on this other than what I've already said. There's plenty of details, information regarding this online if you need that. Are there any other questions, guys? I see we're quite empty here. As I said, there is a recording. Right, we also have, just in terms of upcoming webinars, we have one more for the month of November, and this is, oh, good, that's okay, Dahlia, I hope I pronounced your name right. So Joseph, the next seminar is, webinar, sorry, is on the 25th of this month. Now this is titled Behavioral Biases. Now do not be put off by this title. That is so interesting. It's basically looking at the investor psychology of how we think, and it's really will open your eyes to how we think when we're trading. It's pretty incredible, in my opinion anyway. So I don't see there's any more questions. So with that, please have a great day, and I'll see you all again on the 25th. Thank you very much.